All right. Well, welcome back. You are listening to Dime to Diamonds. I am Suzanne Porske with Phoenix Financial Group, and I am joined today
with Mark Farquhar, Phoenix Financial Group.
Rachelle Harp CPA.
Harp Accounting. That'll never get old. She was by Harp Accounting, and she is Harp Accounting,
www.harpaccounting.com.
Yes. And so, but you are a CPA, so we need to make sure to let everybody know. You pass that really hard exam.
Yeah. 4 of them. It was a blast, though. I would encourage everybody to go and do it.
She's crazy. Okay, so you're going to laugh, but how many times have we recorded this podcast and it hasn't gone? So we're just going to see how this works. The great wealth transfer that's happening right now.
Thank you.
Anybody born between 1965 and 1980 or in this great wealth transfer, they're going to inherit the greatest portion of assets in the next 10 years. They're saying it's totaling about 14 trillion. So helping our clients that are either receiving or that is their wealth is going to be transferred is really where we've pivoted ourselves.
Actually, 124.
Well, I know
That's
on our
crazy.
blog it says 14
Does it?
trillion, but yeah, you could be right. According to Surely Associates, a wealth management research firm, you're right. 124 trillion of wealth will
That's
transfer.
2048. The 14's in the next 10 years.
Okay.
Sorry about that.
So in the
You're
next
right.
10
You're
years,
right. Yeah.
and you're right too.
Everybody's right always.
It's saying that the bulk, 81%, is going to be transferred primarily from baby boomers that were born between 1946 and 1964. And the millennials that were 1981 to 1996 will be inheriting the most of any generation over the next 25 years, 46 trillion. So it's just, I've noticed a shift of people saying, hey, can we gift some of this money while we're still alive and it'd be beneficial?
And the answer is yes.
Yes.
So individuals have the opportunity to give annually $18,000 per person. So if that's a couple, if you're married filing jointly, that would be the $38,000 to each individual. So it's not limited to 38 between the two of you. It's 38 of you together to one child, and then another 38 to another child, and so forth. And it doesn't have to be kids. It can be anybody. But that's what most people are doing. And then you don't have to file any IRS tax forms if you stay under that threshold.
But if you're giving them more than 19,000, then you have to file what form?
9.
And what does that do? It's just letting the IRS know that money changed hands from
one estate to the other. So it's starting to do that ticker on your estate tax, right? And we know that with the new, the recent bill, it's up to
15 allows individuals to gift up to 13.9, but I think that's 15, this now.
million.
30 million for married, yes.
Yeah. And so it's helping also manage the size of their taxable estate. Okay, so it's saying here, for 2025, the IRS allows individuals to give up to 19,000, like you said, 38 for married couples per year without being a taxable event. There's no limit on the number of individuals you can give. So if you're a married couple with 2 children, 5 grandchildren, you can transfer up to 266,000 annually. In addition to those with sizable assets, the IRS allows individual gifts of up to 13.99 million to the heirs under the lifetime gift and federal estate tax exclusion. And so this is where off the air we were talking, it doesn't mean that they can take that amount off of their taxes.
Correct.
It's not like a charitable gift.
No, it's not like a qualified charitable distribution. So, if you pulled this money from your IRA, it's going to show up as taxable income on your tax return, but your kids aren't going to be taxed on it, and it's lowering your estate threshold. Again, that's at 30 million.
30 million.
There's debates on that.
Okay.
The impact on some of the lower
But
individuals.
it benefits who you're giving it. The gift
Correct.
goes to. Yeah.
Correct. But the other piece of it is, when you're able to give it to them while you're alive, you're getting to see them use that. You're getting to help with either student loans. You're getting maybe a down payment on a house. You're able to help put those individuals in a better situation from the get-go.
Okay.
And so that's kind of where I think some of that transition is rather than waiting and just giving people money after you've died, why not give it to people and get to experience the joy with
it, right.
them?
Okay. So I'm also in the blog on phx.financial, because that's what this is where we're talking about it, encouraging you to go read, because we're not going to go over all of this. We do little 15-minute podcast, just kind of wet the whistle and have some discussion about it. But it's talking about donor advised funds are becoming increasingly popular among affluent families who wish to engage in charitable giving. So these professionally managed funds allow individuals to make irrevocable contributions of cash, securities, or appreciated assets. The donor then may be able to claim a tax deduction in that year the donation is made, and then make the grants to a charity of their choice. So is that the Uniform Gift to Minors Act, that they can give that money and then they can deduct it?
No, so I mean, that's really specific to charities, right? So there's an opportunity for people to essentially almost create a trust, but it's not. It's called that specific wording for a charity, and then they're going to give that money to them at some point in time based off all the little written legal language. But it's an opportunity to donate to charities and then use it as a tax deduction.
Yeah, and the blog goes on to say, and we've used this as an example here, like our clients say, I would like to start giving some of these gifts now while I'm alive and create an experience with our loved ones, which we champion because we've been here when those people have transitioned and we've helped them in their accumulation and preservation of wealth. And then we see that people that inherit it and they just blow right through it. And you're like,
just blow through it.
Wow, that's not what we did all those years.
Beneficiary, or those who they're gifting it to, if that person is here, they're probably going to be a little more careful or thoughtful about what they're going to spend money on. So
they can gift them while they're here and maybe make an experience of it, like a family cruise or something like that.
Or may want to treat it as an educational process too.
Yes.
To the person they're giving it to. So
yes, and we're going to go through that. We've realized here that it does provide a great opportunity for financial education.
Right.
It does open up that communication in the family. Also build stronger family bonds. Yeah. Like you were saying. But there are financial instruments like irrevocable trust. We do not do those here in this office, but you can do an irrevocable trust and put money into it. Is that what you're saying?
Yes. Okay. So you can do that. And you have the ability while you're alive to, pull funds back out, but then it's transitioned on to those individuals.
Okay. So if somebody wanted to gift money to their grandchildren and write it off, it would have to go into an irrevocable trust with a tax ID number and taxes filed. Correct?
Yes.
If it earned over $600, I believe.
Yes. Not
to do your job, because you do it great. I've been around 41 plus years in doing this, and I know that we've had some people that have taken advantage of that. There are grantor retained annuity trusts. Those are called GRATs. They let individuals move assets out of their estate while allowing them to access the holdings.
Correct.
That's what you're talking about. The SLATs, the Spousal Limited Access Trust, they offered married couples a way to take advantage of lifetime gifts and federal estate tax exclusions, and then, of course, the charitable remainder trust. And those allow the donor to receive income from the trust for a set amount of time, and then the assets remain at the end of the term are distributed to the donors and all their preferred charities. And does it have to be, when they say charities, is that 501c3, so church?
Yes. Yes, it's going to be nonprofits, which typically have the 3C classification.
Right. Where on the tax returns, like if there's 529 accounts, where does that show up? Like if somebody donated the amount that they could to a 529.
To a 529, the education portion for kids. So if we're talking that where they're setting aside money for children
education
to college or different things like that. So that's going to be on the state return.
Okay.
And you're going to see it in the subtractions and additions schedule.
I know we have here in our state in Oklahoma a lot of, we see commercials about that and just trying to educate people like, hey, I'm not, it's an individualized basis, but I've seen kids that don't take advantage of it because they don't go to college. That's not what they wanted to do. And then that becomes a little sticky.
Or they get it paid for, their college paid for.
Yes, or they're very athletic and they go on scholarships. That's another good point, Mark.
Yeah. But think of it as an opportunity that you're setting money aside tax-free, and it's growing tax-free.
Mm-hmm. Right.
Right. So if the individual, the child, uses that money for that, then it's still tax-free. All the only other difference is if they don't, you're going to pay ordinary taxes on it, which you were going to originally anyway.
There you go.
So it's still one of those, like, yes, you kick the can down the road a ways, but it's not a total loss. It's just a different avenue at that point in time.
Okay. They do have super funding of a 529, and I put that in the blog. That is just saying that the IRS allows an individual to contribute up to 5 times the annual gift tax exclusion, $95,000 in 2025 in a lump sum, and then spread the amount over 5 years for tax purposes. Yeah, so we do have some people that, have asked us about that. And I love it because we can run the reports and see how it's best going to fit for our client, the tax strategy, and also how it's going to fit emotionally for them. Some of them do want to have those experiences. And we've had other podcasts, we've talked about this, where when people retire, they're wanting to not have to work and then they're expecting to see their family more. But the family is doing family stuff, and the families are their own unit, and they've got sporting events. And you and I have talked about that when the older parents are like, hey, we want to meet. And you're like, well, we're picking him up from church and dropping her off here. And
working.
And so that's where they go, hey, I think I want to plan a trip, a vacation where we can all go together. And it's like, that's a great idea. And use some of that money that was going to be left for inheritance to, to use it and to share now. Potential pitfalls and misunderstandings with that is over gifting risks. Before embarking on an intentional gifting strategy, consider working with one of us, a financial professional who can help evaluate whether you might be compromising your own personal finances. Because I had a lady do that. I'm like, you're going to have to stop. You don't want to run out of money. They like to be around you because you're doing this, but they're not going to want to have to be paying for you to live.
Well, and grandma or great grandma really loves their grandkids and wants to help. And this is an opportunity where they can be a part and see and make that impact, right? But there also has to be that well-being of yourself to make sure that you're going to have stuff to sustain.
And then the lack of clear communication. And that's where we like to have our families in here and even bring the family that will be inheriting it. So we have those open lines of communication. Some clients in California, I was talking with them last night, and it's like, yes, I would love to talk to the executor and do that introduction. And then the oldest child who's away at college, maybe we can do a Zoom, or when that child is back. She's already back to school, but on one of her breaks, and just open that line of communication of this is what your parents' desires are. We don't expect them to transition or anything to happen, but this is clearly articulate what the desires are. So in conclusion, gifting during lifetime isn't just about generosity, but it is proactive estate management strategy. Might be able to help you manage your estate tax liability a lot better. And we talked about that even with the big, beautiful bill. Things have lightened up a little bit as far as it's changed. If you are receiving inherited IRA money, never before been taxed, if you don't qualify, then it's 10 years.
Got to disperse that whole amount, that whole balance within 10 years, which could be very impactful for some.
Right. But if you're able to gift it for, during your lifetime, it reduces the amount that they'll be having to get. And then it also, I don't know, I have a different view on money. It's an energy and it's all around us. You're not going to run out of it. And it's to be used and flow and enjoyed.
And I would think that for most people, the other side of things, would much rather enjoy getting to spend time with their parents or their grandparents and having an experience that they can look back on rather than
with
the 10 grand, right? It's one of those, you would much rather have that. You don't want to lose anyone at any point in time, but I would anticipate for the most people that would be their response. That's
what people have said. I don't want this money. I would rather have my dad back. And this isn't what I wanted. And then again, the whole complication. Can't say it enough how important estate planning is. Get the estate planning done, and you can put in your estate plan what you want. So if that family vacation, you can put that in your trust, and your executor will execute your wishes.
Giving them out on their birthday. See people giving money on those days annually. Yeah, to remember.
You're allowing the trust to take control of that and disperse it instead of just somebody. I've had people that were very young that have got large amounts that didn't know what to do with it, and it's really sad because you've had somebody at some point saving money and doing their due diligence and to accumulate the wealth to just have it kind of go by its side. So. All right. Well, we're at our 15-minute mark, and
fast.
Yeah, it does. We're gonna have to get something for your chair. It's squeaking.
Sorry.
It's fine. None of us have pens because I'd be over here clicking. So
I just play with my paper. All right, you guys. We want to thank you so much for joining us on another episode of Dime to Diamonds. This is Suzanne Porske with Phoenix Financial Group.
Mark Farquhar with Phoenix Financial Group.
Rachelle Harp, CPA.
Harp Accounting. And to find us is phx.financial or harp.
www.harpaccounting.com.
We can just say harpaccounting.com.
Okay.
phx.com.
Okay.
I think we all got that because you really need to say HTTPS:/.
Make sure you use the S. I did not know that the S was so important. Like that is like a security piece. So you want the S. Like it makes it
legit.
I'm not IT, so we're going to leave it at that. But the S is important.
Okay, so phx.financial or harpaccounting.com. There you go. That's how you find us. Until next time, you guys take care of yourselves and thanks for listening. Have a great day. Bye.